Ladies and gentlemen, welcome to our panel, Power Moves, Investing in the Future of Energy. My name is Iordanescu, and I'm known for driving transformational change across global energy markets with over 15 years of experience at the intersection of energy infrastructure, sustainable finance, and emerging market development. I help shape policy reform, structured innovative financing mechanisms, and mobilize public and private capital to advance sustainable energy transitions in Africa, Asia, and Europe. I'd like to start with a couple of remarks before I turn over to our distinguished speakers today. The global energy sector stands at a critical juncture, a so-called breaking point, where geopolitical instability, market volatility, and climate urgency are colliding. But perhaps more accurately, it's a turning point, a moment ripe for transformation. Historically, such periods of upheaval have been fertile ground for innovation. Consider the 1970s oil crisis, consider the 2000s solar PV boom. However, innovation is seldom a linear journey. Failure and experimentation are not setbacks, but essential steps in the journey towards sustainable energy solutions. So let's look at this moment of fragmentation as an opportunity to test new ideas, invest in groundbreaking technologies, and accelerate the transition to a resilient, sustainable energy future. Because energy, how we produce it, finance it, and use it matters most because it is the foundation of every system. This is a pivotal moment for the global energy transition. So this session is about exploring how finance can be a force for speed, scale, and systemic change. Galileo is said to have remarked, "Eppur si muove," and yet it moves. A reminder that despite resistance, the momentum of innovation persists. And on that note, I would like to turn it over to our distinguished speakers. So, welcome. Starting with Max Horst on my left here. He's a managing partner with Rockstart Energy Fund. He's offering early stage startups access to capital, market expertise, and community through a customized startup support program and follow-on investments up to Series B. Max has been active in renewable energy since 2003, a veteran. When he helped Essent, currently RWE, establish their wind business in Germany. As director at EWT, the largest Dutch wind turbine manufacturer, he was responsible for corporate finance, business development, and strategy. Further, he was a co-founder and CEO of, this is really exciting, eKite, an award-winning Dutch startup which developed airborne wind energy systems. Before entering the renewable energy sector, Max worked several years at McKinsey as engagement manager. He holds a Master of Science degrees in chemical engineering at the Delft University of Technology, business administration at Erasmus University, Rotterdam, and an MBA from INSEAD. Welcome, Max.
Thank you.
Continuing to my left also, Polina Andersson. Thank you for joining us. She's a VP for Financing and Treasury at Enery. She brings extensive experience in investment banking and finance, focusing on large-scale transactions across Europe. At Enery, she leads financing and treasury efforts to mobilize capital for renewable energy infrastructure. Her insights are key to understanding how to make energy projects bankable in today's volatile environment. So you will be very popular today. Thank you for joining us. Manuel Heckmann, a partner at Greencode Ventures, is an impact investor, Manuel, an entrepreneur focused on green mobility and deep tech. As partner, he supports early-phase digital-first green transition startups. With a background that includes founding EcoG and broad experience at Zero Mission, Manuel brings innovation and capital to scale disruptive energy solutions. Cannot wait to hear about that. Thank you for joining, Manuel.
Thank you.
And last but not least, Markus. Markus Wagner, thank you for traveling all the way from Palo Alto, is it? Whereabouts?
Vienna.
Okay. He's a chairman of the advisory board at i5 Invest, a founder, i5 Invest, i5 Growth. He's a renowned entrepreneur and investor for over 20 years, a founder of the two that I mentioned above, Austrian Business Angel of the Year in 2010. So for those of you on the lookout for an angel investor, he's here with us with strong ties and presence in the Silicon Valley. With a track record in scaling tech and energy ventures, Markus offers a critical lens on the fundraising environment and strategies for energy tech companies. Areas he's active in are smart grid automation, energy trading, battery optimization, monitoring, EV charging, energy communities, energy management, all that easy stuff, right? So thank you so much for joining us here. All right, so let's dive right in. I'd love to start talking about how we shift from incrementalism to transformation. How do we move beyond small, gradual changes toward comprehensive systemic overhauls to advance energy innovation? So, Max, if I could start with you.
Yeah.
What do you think is one power move that we need in the next year or so to move energy innovation forward in this fragmented world?
Yeah, thank you. You're referring to a fragmented world, right? And what we see is a world with a lot of geopolitical tension at the moment, a lot of polarization, also a lot of uncertainty. And what I see in the energy domain in general is now that the primary concern of energy is actually shifting a bit from climate change to energy security.
Mm-hmm.
Can we rely on our energy system? Can we, how vulnerable are we for cyber attacks? Can we have access to energy if some Treasury country tries to block us? So. We very much, and especially I think now what we see, what we saw a few weeks ago in Spain and Portugal, it shows like how dependent we are as a society on reliable energy. So I think that's at least a topic we look very much into. And there's one, maybe even two, I would say, power moves of things that we need to do in our view. And one is really actually related to what happened in Spain on the grid side, right? So there needs to be massive investments in grid, but also regulatory reforms to move much faster, because now it can take a decade or so to get a permit, in combination also with smart grid technologies to make better use of the grid. So I'm based in the Netherlands, and the Netherlands is unfortunately not in soccer, but in grid congestion we're world champion. So in the neighborhood where I live in Amsterdam, you cannot build a new supermarket because there's no cooling capacity, because you don't have the grid capacity. There are cities where you cannot accommodate industry because there's no grid connection. There's a big city called Almere, which is one of the biggest cities in the Netherlands. They cannot build housing blocks because there's no grid connection. So you see how much impact lack of grid capacity has on society, on jobs created, and of course also on the uptake of renewables. And there's several things you can do there. The other big challenge I think is on the geopolitical side. So as Europe, we obviously push for the energy transition to reduce the pace of climate change, but also to get less dependent on oil and gas imports. But at the same time, we also create a dependency on another dependency on minerals and metals. So if you look at, for example, rare earth metals, which are quite crucial in the energy transition, 85% of production capacity is in the hands of China, basically. And I've experienced it firsthand when I was working at this wind turbine manufacturer, what that means, right? So it was like the year 2011 that the prices of certain rare earth metals that were used in the magnets of those turbines went up 1100%, which completely rendered our turbines uneconomical. And that's small beer compared to what happens if, for example, the situation around Taiwan escalates. So that's, I think, another area where we need to act very quickly.
From a regulatory perspective, you mean?
If you look at the grid side, I think it's to a large extent regulatory, because I think there is, but we'll get to that, I guess, there's quite a bit of capital available, so the amounts are huge, but there's really kind of getting permits for the grid, but also allowing startups with smart grid technologies to operate. Mm-hmm. And there are also some really weird incentives in the grid market that goes against innovation. So there, I think there's a lot to be gained. When it's about geopolitical independence, I think it's more about as a government, I think we can provide more grants and stuff like that to basically boost innovation in Europe on that field.
So with that in mind, that appears to be a power move to meet the momentum of the deep need for transformation. I'd like to turn it over to you, Markus, and ask you on this note real quick. Do you see a tendency to finance more safe bets or breakthroughs to meet this need for deep transformation of systems to sort of respond to the climate urgency?
I think it's two different type of investors who go for the safe bets and the one who go for the breakthroughs. I was wondering, like one side question: who of you are basically running an energy startup and planning to fundraise at some point, or are you 1, 2, 3, 4-ish? Yeah. So the safe bets are like wind farms, PV setups, business models from other regions where you can do your spreadsheet work, and the area you guys are in, for example. And in opposite, if it comes to breakthroughs, they're more like on the venture capital side, also different kind of financings, no chance you go to a bank. And it's more on the deep tech side. So we have, basically it's like two worlds, right? We actually don't do any projects which do like infrastructure financing, leverage financing and so on, like you guys do. Or like big project developers don't invest into like tech product type of energy tech companies. You see both. The bad thing on the breakthrough is you cannot go to banks, which usually leverages the amount of capital that is going in. And you're basically limited to business angels and venture capital and public grants. And that's a big disadvantage. If you compare that to the US, for example, the US, like it's only about like a business case. Nobody is motivated by impact, or like not anymore by any political will. Right? Like Biden did some infrastructure, energy act, work money went into project developments, like on the solid business models. And there also went money to kind of the breakthrough technology space in the US. So that's shifting there. In Europe, you still have both. But you cannot expect that like American investors invest in Europe, or you also cannot expect that European investors invest in the US.
Thank you for that. And that's a good segue to this question that I have, starting with you, Polina, because of your work. And obviously it's about capital. Everyone is thinking about capital. One could argue, supported by data, there is enough capital to support the energy transition. And I've actually looked up, real quick at S&P 500, for example, says that There is, in 2022 actually, private equity and venture capital investments in European traditional, safe bets I suppose, and renewable energy companies saw a significant increase. So we're looking at, 2024, the EU invested approximately 370 billion in clean energy, maintaining the position of EU as the second largest investor globally after China. So they're, at their face value, these numbers would show, okay, the money is available, capital is available. So would love to speak with you, to start with you, to talk about accessibility. How do you access that? So the question that I have in mind is in the framework of power moves and shifts, right, that are needed to meet the momentum of transformational change. What's one structural or behavioral shift that we need to make so that capital become accessible? How do we better align investors, for example, or developers and communities around long-term goals?
No, thank you, Georgia. And I find this question very interesting. So I try to make a practical example to make it more relatable. In renewable energy, in established companies like where I work, where we already have a portfolio of PV plants and wind parks, the flavor of the month currently is batteries. So storage is really something that we are very focused on, and all the IPP players are targeting to bring flexibility to the market, meaning that we can provide the base load, i.e. Every hour of every day we can provide you the same amount of energy and provide you stability. The hardware is there, so we can order batteries, there are suppliers. The software which connects the battery to our PV plant is there, and there are very, very intelligent people who create algorithms to maximize the battery, that it can deliver the highest return. But then there are bankers who do not fully understand the technology. And this is coming back to George's question. Technology is running very, very fast, but the finance is lagging behind. And I had so many conversations with different players today, and I truly believe that my answer to that question is relevant because I think it's about enhancing dialogue between the stakeholders, which means that entrepreneurs and companies like mine need to be patient enough to explain to the bankers and investors what we're really doing, and the bankers need to be slightly less arrogant and admit that they don't know it all, and have the willingness to learn about the new technology. But with this product, for example, bankers are not ready to put very high leverage, meaning high amount of debt. However, battery has a much quicker payoff period compared to the PV plant, which is absolutely illogical, but it demands a very transparent conversation. So I really would suggest the simplest open dialogue, and this is the behavioral change which I would suggest.
Manuel, please.
Maybe adding to that, so we have the startups or the technology providers to review, but then we have the banks, and the worst then comes later, and that goes to you, Max. That's the regulator. If you want to put up a battery energy storage system next to a PV plant in Germany, you need to have a pond filled with water for fire extinguishing. Nobody uses water to extinguish a fire of battery energy storage. You have to use other stuff. But for a regulatory, you only get the permit if you put a pond with water there. And that's very interesting in that case. So the regulation lags. And I think also when you think about bankers, if the regulation would give them a little bit more comfort, I think they would be nudged to push it in that way.
True, but this is again bringing all the stakeholders to the same table and having a casual chat with one another where not someone is smarter than another. We all have our knowledge to bring to the table, but to share it with each other and bring all the parties to why we're doing this. And I think the goal of achieving the sustainable future for all of us is there. So I think all the parties agree on that, but we just need to encourage each other to learn from one another.
Isn't there also like a kind of European angle, right? Because I'm not a battery expert, but I think with batteries there are many business cases. So the technology might be complex, but the business models even more, I would say. But they also differ per country, right? Because there are different incentives and different market structures. Therefore, it's very difficult to scale. I think there's also a world to be won to just have, let's say, one set of incentives across whole Europe, right? Because then you can scale, which is always the essential problem of the US versus Europe. Is like, yes, you have like one big market to a certain extent. Here you don't.
Yeah, true. This is where United States of America, not United States of Europe.
Yeah, indeed.
So on that note, I'm going to ask the question. I think, Markus, you might be in a better position to answer this because you work across both Silicon Valley and Europe. And my question to you is whether you see key differences between the investor appetite and risk tolerance between the two.
Yes, there is a big difference. So if you're fundraising in Europe right now, like if I would be an energy tech startup, I would not fundraise until I have fulfilled like at least one of the three criteria. The one is I have revenue and can show numbers. The other thing is I have really like kind of, nobody can hear it anymore, like kind of Rockstart team. But not on my advisory board, like 1 hour a month thing, like full-time committed people who already did that. And the third one is I have a topic that might be a strategic fit to a strategic investor or a corporate VC, or might be the passion of one business angel because he like did his PhD work around it. Mm-hmm. So if you don't like fit in one of those three categories, I would not start yet. I would get for public grants, bootstrap, friends, fools and families, pay with shares, because you're most probably going to waste time. You could have generated revenue, which would at least be some money, right? Or even more than the funding you would get. So that's the reality in Europe, especially in the last 2 years. So it really got worse. So we are in the worst fundraising period in the US and in Europe for a long time. In the US, there's a big difference. You can get like funded on a PowerPoint, you can get funded on a resume, you can get funded without any like revenue requirements. What would be like a seed requirement list in Europe would be a 3-seed requirement, would be like would potentially be already like a Series A case in the US. That's one aspect. But you don't have public grants in the US. That's a very good stimulus in Europe. And you don't have a lot of political will to invest into energy transition at all. What you see in Europe a lot is a lot of corporate venture capital investors in the energy space, which are like close to a utility or to a grid provider, and you have one in Finland, you have one in Italy, you have one in France, you have one. So the granularity, the small granularity in Europe also could be, from a perspective of a startup, could be a benefit because you have how many energy tech funds are we in Europe? I don't know, like 60, 70, 80, right?
80.
And then you can
Green
also
transition fund 80.
You could look at it. You could look at your business model from different angle, right? You can say you are energy. You could also say you are impact investments, so you also ask the impact investors. If you do like AI-based energy, electricity trading, you might go to the AI investors. And because you do trading, you might go to the fintech investors. And because you have a recurring revenue SaaS model, you might go to the SaaS investors. So you need to like work your way through. That's similar in US and Europe, right? But that's the way the reality is. And the reality right now, here and there, is you need 9 to 12 months as everything works fine. Think about how much revenue you could make in like 9 to 12 months. And if you go fundraising for the next 9 to 12 months, how does your traction looks like in comparison to a scenario where actually did sales? So that's advice I'd give to kind of not start a fundraise early, rather like to wait in Europe.
And on that note, I want to turn it over to you, Manuel, because you're both an entrepreneur and an investor, right? So I'd like to switch a little bit the discussion towards scaling, what I think sometimes appears to be unscalable. So how do you see investors' expectations like speed of return and scale shaping the kinds of energy solutions that actually get built?
I think again we have to differentiate between like the hardware side and then the software side. On the hardware side, working with a venture capital firm is sometimes challenging because we have a certain perspective and we have a certain lifetime of a fund. Yeah? So when you sign up with a VC, we need to basically get rid of the shares in 10 years latest. So normally 7 to 5, because also we have to return money. That's the beauty. You said family, fools and friends or business angels. They are not in this vicious cycle. We are, because we also have investors. So it's not my money. Somebody else gave us money. On the software side, I think you can scale, you can show, you can also, let's say, hardware-enabled software side. And there it's really about finding the first clients, signing them into a multi-year contract, and then kind of very often the companies that we are part of, it's not yet fully materialized, but basically on paper you see where the road can go. So for us, that's paper value, but kind of if there's a contract behind, the contract runs a certain period of time, there's an automatic extension, you have a certain scale-up plan of the client, that 50% of that you should scrap because they also have delays. I think that is one part. I personally would say never try to sell to a utility because that's the worst sales cycle you can have in the energy space. But unfortunately, it's something you at a certain point in time will. And for me, that could be that point that you refer to, like when is really this scale happening is when you are able to deliver on a countrywide grid or multiple countries, and then you normally work with either a grid operator or a utility. But when we look at companies, very often we would like them to find a way to circumvent the incumbents, because the incumbents are the slow ones here, and they are also coming back to what you said maybe about bankers. Why are suddenly neobanks so successful in the B2C area? Because they circumvented the way you interact with the client. They said no branches anymore, everything online. There's a telephone support or whatever, or even a website, and you do everything through the app. So I think this is the way we want to see companies, and I believe that's also the power move here is really to get around the incumbents and fix it from the other side.
I love that when you talked about scaling, you said when and not if. You did not make it conditional, but we all know there's uncomfortable truth here to recognize failure is part of scaling or lack of scaling.
Well, it's the part of the business model of every VC fund. So we look at the portfolio, we hope they all make it. We know they don't. And the first decision point is basically 12 months after investment to make the decision if you give them more money or not. Or if you participate in the follow-on round. And to be honest, in the current climate, I believe I kind of have high hopes for our portfolio, but I have to face the truth that probably like, I don't know, 50 to 60% need a bridge financing. And then it's the first point where I have to make, or we as a team, but ultimately, if you are the one who's responsible for a team or for a deal, you look into their eyes and say, no money. And you know what it means. It's basically, they will not continue, or well, maybe they found somebody else.
So I'd like each of you to chime in on this one, because I think it's important, as uncomfortable as it is, to talk about failure, because if we don't, we miss the opportunity to learn from that experience. And what I mean by failure is a situation where perhaps the venture did not have the impact anticipated, is too soon to tell, or it just, was not viable throughout. So from your experience, what do you think is the message you need to tell someone out there in this room who is a startup, an entrepreneur? What do they need to know about failing and just picking up and trying again in terms of their business model, in terms of their pursuits to secure funding, in terms of collaborating, having a dialogue? What would be your sort of giveaway from what you have experienced? So Max, maybe starting with you.
We also have at times startups doing bridge rounds, right? Which is in principle not very attractive for an investor, right? There's no uptake in valuation, and you don't know if it's a black hole or not in which you put the money. But I think in general we look more favorable of startups that keep us really in the loop of everything, right? So one of the things we always advise to startups is like send a newsletter every month. Because that gives, that's also how it works, right? It's also a bit of an emotional connection you have with a startup and a gut feel, and afterwards you try to rationalize it with numbers. But in the end, typically the decision is still partly, even though I'm not allowed to say it, I guess, but in the gut. I think that's super important. The other thing is still, as mentioned, really start early enough with fundraising. We was at 6 to 9 months, so maybe right now it's even longer than that. So. That's those two tips I would like to give. Yeah.
So the ones who already started the company, right? They are already like open to failure. So they are halfway through. Like I would argue, like with a lot of consultants or people who work for an agency, that they should start companies as well, and they are the ones we should encourage also to be open to failure, because like it's very easy to, especially in Europe, what should go wrong. Then nothing can go wrong. It's you keep your social security. Everyone still likes you. You find a job more easy after. You learn much more. So there's at the end of the day there is almost no big side. On the failure side, there is one saying in the US, but like to everywhere, it's like fail fast, right? Also the US, they don't like failure so much too, right? Like they wanna like. Investors also want to invest in the one where they think they win, right? And if it fails, they also not happy about it, right? But there's the question is like fail fast, and that like also means fail cheap, right? If you fail fast, then you can learn on a very iterative way in very small steps. That being said, you also need to talk about and show your product to someone able to fail fast. And that's more the agile way of like working in product development. Do not like invest into a 5-year development plan and after 5 years figuring out when talking to the first customer no one needs it. Starting to communicate to your customers, try to sell it very early even before you started it. So you figure out that you might need to change your direction like very early, and you can change your direction 500 times compared to one time and sunk the cost. You most probably going to end up on a totally different destination if you go 2 smaller steps than if you would have thought you might need a major plan.
Polina?
I think it doesn't really matter whether it's a small entrepreneur or a mid-corporate or a big corporate, but I think I want to iterate the message that when you feel there is potential issue, you need to start communicating it very early to all the stakeholders. because I think there are always many intelligent people in the room who are willing to be very helpful. But if you hold it till the last moment, then it's more like my 3-year-old at home who will hold it and not tell me, and then, when things really go bad, then things are bad. But I think it's very challenging to change something when it went too far. But if you started to discuss with stakeholders early on, there for sure will be help. And might be there needs to be some changes on the way, but you will be guided through.
So it sounds to me like there's a lot of emphasis on the, recipient, on the, entrepreneur side when it comes to being on the learning curve. But on the institutional side, do you feel these lessons are also incorporated into adjusting, being more flexible, accessible to different categories of sophistication when it comes to understanding the capital needs and so on and so forth?
For sure, I think that's how entire risk policy of the bank is built, based on the learnings and mistakes that they did before. So risk policy of the bank, having my investment banking experience, is not built out of nowhere, but they did fail, they did try to finance something, it didn't really work, and they readjusted. So it's kind of the system which feeds each other.
Manuel.
That's why we have interest rate and discounts and convertible loans. Because at the beginning, I don't know, when venture capital started, probably in the 40s in the US, you just got money, and then you failed, and then somebody thought like, there's risk with it. I need interest rate, I need discount and stuff like, and I need to have stuff like that. Coming back to that, I've been on that journey a couple of times. So failure is part of it. And I really like how you said it, Markus. Iterate fast. Failing is part of the way you do. And I think it's also like sometimes you have to grind through. So it sounds really discouraging because it's tough and it's gritty and you have to be resilient. And I think that's what we are looking at when we are looking at early stage founders. Can they grind through it? Because kind of sometimes it's shit, and you ask the question on the 15th, like, how should I pay my people at the end of the month? And you have to get through it. So I recommend coaching all the time, or therapy even. That also helps, out of own experience speaking. Coming back to what you said, Mark, investor communication is probably one of the single most important tasks of the CEO or the founders. Because it's harder to get rid of than your spouse. So getting a divorce is easier than getting rid of your investors. And that's also very important, and we want to be the ones, and I think that's also very important. Call us or talk to us even if shit hits the fan, because we are in that together. That's why we take equity. We're not giving you a loan, we're not a bank, we are a shareholder. So we live from the fact that the founders are successful. And then turn it into an exit at a certain point in time, and then that's the only moment we get money, and we all get money, and then we hope it's going to be a return or a reward in that moment.
So it's funny because in grad school, I remember I had a professor who said the number one rule, it's a rule of thumb, as they say, when you're an entrepreneur, you need a partner with a steady income that absorbs that,
Helpful.
Excellent, yeah, absolutely. So, look, this is, I think, helping the audience. I'd love to let the audience know that we'll take questions if they're burning questions. So make sure everyone knows. So there's a question already. If others are thinking, well, I'm going to give them the 2 questions. Perfect. Before we turn to the questions, there's one thing that I think it's worth reiterating, talking about iteration, Markus. So we talk a lot about raising money for energy tech companies today. I do feel it's worth unpacking it a little bit, if you will, to just say what that is, but also telling everyone, from your perspective, what's one myth you would bust about raising capital in the energy space? So I'll start with you, Markus.
I'm not sure I got the first point.
So the first part of the question is if you can unpack what it means to raise capital in the energy space, in the energy clean tech, and the second one, they can be combined. What is a myth that you would bust that's not valid about raising capital? A misperception?
Yeah, it's. I think it's like the misperception very much on the timeline and how much work it is, right? I mean, if you talk to someone who's fundraising, you know, everyone says like, business is growing like hell, we're tripling, we're doubling, like we are hyper, it's skyrocketing, la la la. So investors are knocking on our doors and they're lined up and so on, right? So they give you like a wrong reality. And the investors who desperately want to invest, they also give you a wrong reality. They usually say, we have done investments in 4 to 6 weeks, very fast. We have a super international network, we can help you everywhere, right? So, it's also wrong, right? So you get like the intelligence of the people in the room then, but like you shouldn't expect much more. So I think that's the two things that are relevant to know. And that brings me back to the very first thing, like try to do revenue, because it gives you the timeline for the 4 to 6 weeks, which are not 4 to 6 weeks, and it gives you better numbers, which helps you convince the investors. How does like fundraising for energy tech startup at the end of the day really looks like? Not different than in any other space. If you work on the product side and not the project development side, build your relationship early on with the investors. If you were like an energy tech startup, right, like add us on LinkedIn and send us what you do and keep us related. So if you're friends on LinkedIn, we see your posts, we see what you're doing, we kind of follow, build the relationship. What's also relevant, true for every other vertical too, it doesn't help you if everyone is your friend. You need to like have someone who falls in love with you in order to get the investment, like in a marriage. For those where you think like those are the candidates, you really need to work into like that relationship with the people. They need to like you, you need to like them, kind of like start to become friends, and not like kind of spray and pray and hope that like someone is at some point throwing money like at you.
No, thank you for that.
I need to apologize. I need to run because I need to go to the ultrasound with my daughter. But like again, LinkedIn. Every one of us is like on LinkedIn and trying.
Thank you very much, Markus. Yes, Polina.
It seems that the topic of marriage is kind of popping up.
No, it's worse.
So yeah, I will maybe continue on that regarding the myths. I don't know how many are married in the room. Raise hands. Would you agree that marriage is all about compromise for it to be good? Yeah? No? Partially. Okay. I think the relationship between entrepreneurs and any type of industrial company or company who functions with financial institutions, this relationship is also a compromise. So I think it's a compromise between, today I heard the phrase financial impact and financial return. So I think for both, there is a middle point where you're going to meet, but there is not going to be a magic deal which is so perfect for one party. It's always a compromise. So this is my outcome.
Thank you.
Yeah, maybe one of the myths is that you're only a successful entrepreneur if you got venture capital. Mm-hmm. So I think what everybody needs to be very clear, so I'm a VC and I'm very passionate about it and I really love what I'm doing. But in many cases you can be very successful without taking VC money. And particularly in Europe, I think what Markus said is right. There are grants, there are customers and so on and so on. I think that's really one of the most important parts to understand.
Thank you. Max?
Yeah, I think I can, by the way, very much relate to that. And I sometimes also see that nevertheless startups then are actually seeking VC money, and then that's not a happy marriage.
No.
Because they need to have big returns, and then you get like misalignment on return requirements, and that's not good. Yeah, maybe one other myth is that with hardware startups it's super difficult to raise VC money. I mean, there are challenges, right? It's typical capital intensive. There's a long time to market, and often long sales cycles. There's bankability issues, but on the other hand, there's no energy transition without hardware, right? And we need to, I think, increase hardware investments sevenfold. And that also requires a lot of innovation. And there's a lot of attention now also on the hardware sector. So it is in a way booming, but still you need to try to make it, if you go for VC investment, make it more easy to fit the VC model, which means like in the beginning R&D grants. Unfortunately, there are quite a few in Europe, seeking soft money for pilots so that you have track record, which is super important. And also, like if you go to market, seek, for example, government guarantees to make up for bankability issues, because startups have very weak balance sheets and therefore it's very difficult to sell hardware. But for example, Germany, you have like Hermes who can help there. So there are definitely ways to also flourish and attract VC money even as a hardware startup.
Thank you so much. I recognize, we're almost at time, but I want to give the opportunity for questions. And if we can take both questions, if you can just, make sure you have a microphone.
You were saying, you were talking earlier about how slow everything is, right? And trying to circumvent grid operators, infrastructure, and so on. Do you see any opportunities in the market in terms of like technology, behaviors, whatever, that will make it faster for a startup to take it?
And can we also take the second question and then we'll answer both? Thank you. Thank you.
Thank you. Peter Bronsky, AIT. I think similar direction, the bottleneck of the energy transition are the grids. I think we all agree. We will have to bring decentralized energy production into grids which basically cannot handle. And we have seen this in Spain. And Max mentioned you have to wait a decade in order to get a plant activated in the current grids. The grid operators and the infrastructure is outside of the typical startup investment innovations scene. What is your idea on how to bring this quick build, move, test, validate into that area of infrastructure building in that area? That was the question.
Yeah, maybe I try to address the first one. So ultimately you probably end up with them, but what we see, for example, in Ireland, hopefully we will do the investment, is a company in the space of renewable asset management and asset operation a little bit, and they basically help their clients to organize the relationship to sell the energy directly to a data center. So basically the wind farm in that case it's a wind farm, it's set up directly next to a data center, and so basically that energy never goes almost into the grid. There is a grid connection as well, but there is also the connection directly to the data center itself, and that could be a solution. And basically where do we end up with that? It's microgrids. And I think microgrids, peer-to-peer energy, that's stuff where I see. The other part is when you think about industrial green transformation, what is happening? A lot of corporate buildings get solar panels or PV panels. So why do I need to feed it back into the grid? I could either put a storage into the basement, I can immediately live off that. And so again, microgrids, and again, this like management, that's where I see a way to kind of circumvent the grid incumbents.
Maybe to build on it, because we do have a couple of startups that in the end also want to address the DSOs, the grid operators. But quite often their technology is also applicable to the customers of DSOs. So for example, we have one startup doing transformer sensors. And in principle it's for grid transformers. The DSOs are even slower than the government, I would say. But, for example, a wind turbine manufacturer, they also deliver trafos for wind turbine, right? And if then something happens, the wind turbine goes offline. And they can act much faster. So there, and the same with you can either again, offer your services to a DSO or to, let's say, a big energy consumer that's really dependent on the grid, and if you have, let's say, analytical software that predicts grid issues, it's also super valuable to them. So this way you can circumvent it. But in the end, if you actually have a DSO on board, it's actually the best customer you can get, because they're in there for a long time. It's very recurring.
Thank you. Did you want to add something?
Yeah, so as a typical entrepreneur, right, so you also might go for where the opportunity is and where it's realistic. So if it's very, like, if it's just like hard, because you need the grid operators and they don't want it. They quite often say they can't do it, but in reality, more often they don't want it. Also commercially, it's a lot of lobbying, so they don't support like models. You might go where there is that opportunity. It might be in another country. We are invested in a company that is doing energy communities. That's very different in Europe in every country. There are some countries which are better, there are some countries which are worse. So you might go to the ones which are better, and you might do some lobbying in the ones which are worse, because at the end of the day, governments can make the law where they can rule you don't need a water pond, or you don't need to or defining fixed response times of the agencies. That's how I would take it.
I feel we're at time, but I do want to, can I have one more minute? A rapid fire here. So I want to take advantage that everyone is still here. Thank you so much. You're almost leaving, but this is a fill in the blank type of question, so it should be quick. Manuel, starting with you. Markus, starting with you. If we want to unlock the potential, the full potential of the energy transition, the one thing we need is, your turn.
Deregulation and tax incentives.
Okay, so deregulation. Polina.
Clear communication.
Communication.
I also go with deregulation.
That was taken. One more.
Then tax incentives. No, I think you have to make it more attractive in any way to embrace it, and then it's attractiveness for investment in that space.
Okay, Max.
We need more unity, I think.
Unity of?
In Europe, of energy markets, of regulations, of interconnection of grids, etc., etc.
Okay, wonderful. Well, thank you so much to the speakers. I hope you enjoyed the session today. We certainly had a good exchange on the stage here. I hope the energy carried over to you. Thank you so much for the opportunity.